Want to welcome everyone to the Managing Winter Cash Flow webinar. We're going to spend about an hour just talking about some issues that we may have in common regarding how to get through the winter season and on to the summer season, where a lot of businesses make most of their cash in Maine. Just for let me. I am Dominic. I just want to confirm I'm sharing the Managing Winter Cash Flow PowerPoint right now.
You are. Yep.
Okay, good. All right. So we have two presenters today. This is myself and Dominic Effer, who's the branch manager for TD Bank. I'm going to let Dom introduce himself in a moment. Um, and a couple of words on housekeeping before we start. This session is going to be recorded, so please turn your camera off if you don't want to have your face recorded for posterity. And keep yourself on mute. Please submit any questions you've got via the chat. I'll be monitoring that. And we are really grateful to have Dominic from TD Bank here with us this morning, because I think a banker's perspective on this is going to be invaluable to everyone on the call. And we're not endorsing TD Bank, but I'll endorse Dom because he's a great guy and is going to provide you with lots of great information today.
Thank you.
So we're going to start with a poll, and we're going to ask, is your business seasonal, year-round, or are you thinking about changing from year-round to seasonal, or you're not in business yet? So all you need to do is scan that QR code with your phone. It'll bring up the survey, and I will stop sharing this screen, and we'll take a look and see who's in the room. Okay, let's see, share screen, and it's going to be this one. And as you folks can see, you can also go to menti.com and use this code if you don't have your smartphone with you. I'm going to give it one more minute. Looks like we've got some folks online that are not going to share, and that's perfectly fine. Okay, let's see. We've got 9 participants. I've got 5 out of 9. We'll give it one more minute, 30 seconds more, and then I'll close it out. All right. Well, it looks like we've got a mixture. We've got 3 folks that have year-round businesses, and we've got 2 that are not in business yet, and the others are mysterious. So we will go back to our presentation and keep on going. Okay, so hang on a second. There we go. All right. So my background is I'm a small business development center advisor for Hancock and Washington counties. I spent 35 years in sales and marketing with software startups. So always with small businesses, trying to get them to an equity event. And my focus was building sales and marketing. So I usually ran sales forces. So my perspective when I am working with my SBDC clients is always, how are you getting your sales? How are you going to feed the beast? And work a lot on marketing projects, but I also do a lot of work on cash flow projections, helping folks get bank loans and so forth. I also was a CEO for Strive International, which was a workforce development agency in New York. But also maybe relevant to this discussion is I own Pugnuts Ice Cream and Gelato Shop in Surrey. And sort of live this cash flow for the winter, cash flow versus the summer versus the winter all the time, trying to figure out how we're going to make it to the next season and have enough money going through the winter. Dom, could you introduce yourself, please?
Sure. Hi, my name is Dominic Efter. I'm currently the store manager and vice president store manager of the TD Bank branch in Ellsworth, Maine. I started back in banking in 2001. I started with Citizens Bank a long time ago. And what I've been doing for the last 22 years in the banking industry is basically leading teams. So I've been in the branch management side. Prior to banking, which isn't on here, I worked for re- uh, discount retailing. So I worked for some companies named, Zare Department Store. Somebody will remember them. Bradley's, Caldor, Chow World. If they're out of business, I worked for them at least once. And I did discount reach. So I was always managing teams pretty much for the last 40 years of my life. What I specialize in here, besides managing a team of five, I specialize in small business lending and deposit services. So anything a small business needs from top to bottom, as well as consumer clients, we can help with, and I can help with. Um, I'm also a former chapter chair of the Ellsworth chapter of SCORE. SCORE used to be in Ellsworth at the Mill Mall. They now combined it into Bangor, but I was the chapter chair here for 3 years. Well, 1 year as chapter chair, but part of the organization for 3 years. And I too am also a small business owner. I own Bayview Escapes Travel. It's a small travel business that I run basically out of my home. And like every small business, it's not consistent cash flow. We go up and down, and it's travel agency. So in the last few years with COVID, it went mostly down, but we were able to manage through it. And hopefully, the content I provide today will help you guys out as well.
Thanks, Dom.
Thanks.
So very quickly, for those of you who are not familiar with what the Maine Small Business Development Centers do, just a quick rundown. Our services are completely free. They are confidential, and you can use us as much as you want. So we have clients that are starting new businesses that we help them just get themselves organized for that. And we have people who are longtime business owners who might come to us because they are preparing to apply for a loan or they need help with their marketing, HR, and so forth. So we do lots of different things. I would encourage you, if you do not have a Small Business Development Center advisor, go to mainsbdc.org and sign up, and we would love to be of assistance to you. Just to get us started, here's some of the things that I hear, and maybe I'm also a little bit projecting on other businesses because I live it all the time. But common statements that we get, and we recently had a session with the Heart of Ellsworth where we were polling business owners, and one of the biggest issues that they worry about is how do they retain key employees over the winter season, particularly if they're going to close. So a lot of small businesses may elect to stay open just to keep those key employees whole. Yet at the same time, they're suffering from a cash flow perspective because they're not really making money in the wintertime. It's a very common conundrum that small businesses are trying to deal with. The second one is if for those of you who have existing businesses, when you go into the winter season, particularly in Maine, where so much is driven by the tourist trade, you start worrying about cash. Will I have enough cash by spring to just open? Or if I'm running year round, am I going to run out of cash by the time I hit June? What am I going to do about that? I'm seeing my checking account just go down all winter. There's no money coming in, so I'm stressing out. But the big question is, and I had this with my ice cream store, Pugnuts, is do I stay open and run a small loss or do I close and run a bigger loss? Is it going to be a big loss to stay open? And so I actually kept open year round for 3 years just to get some baseline data so I could understand, is it feasible to run in the wintertime or not? And of course, I had this issue about retaining key employees. So I'm going to just tackle the key employee question first. Because there are some things that you might be able to do about that, and I'll sort of share my own experience. The first one is that communicate with your key employees because you might be pleasantly surprised. That's how it worked out for me. I was thinking about going to a seasonal model, but I was really worried about my production manager who this was her only job. And it turned out that the summers were so rigorous. She wanted some time off in the wintertime, and she was perfectly happy to cut her hours way back in the wintertime as the shop was closed. And so she went from working 40 hours a week to maybe putting in a day or two in the wintertime. Um, she tried going on unemployment, and that was fine, and she sort of did that. But we also talked about another option being I could provide her with a stipend where she would be able to work at another job that might not pay so much, but I would make her whole and give her more money in the wintertime, but less money than she was earning in the summertime. So less than a full payroll, but a stipend to keep her going through the winter. Um, Thankfully, that didn't uh, pan out. That wasn't something that we had to do. Um, Another technique that I've seen companies use is they will establish with their employees in the fall before they close for the winter that there'll be a spring rehiring and a start bonus of some sort, just to give them that incentive to hang on by their fingernails until you're ready to open up again, and they would get a little bit of cash for staying there. The other one that is also effective, if you're able to do it, pay your employees little bit more than you might necessarily pay them to both reinforce the fact that you consider them to be a key member of your staff, but also, frankly, it makes it a little bit difficult for them to say, well, I can go move over to another job, but I'm going to be earning minimum wage or maybe a little bit better than minimum wage, not what I'm earning in the summertime with your business. So those are some potential techniques that you might want to consider if you're worried about employee retention over the wintertime. So on to the discussion about cash flow in the winter. I guess the one question to ask is, does your cash flow look like this? And I've masked the numbers a little bit, but I've taken some numbers from my actual business from a couple of years ago, just to give you an example. Gross profit, just being your cash in minus the cost of goods sold, can look positive for every month of the year, even though, as we know in Maine, January, February, March, April, May, those are sort of the shoulder months. And then October, November, September, October, November, and December are the other shoulder months. Gross
Eric, are we
profit.
supposed to be seeing a spreadsheet?
No, we're just looking at a graph right now. Can you
No
see a graph?
graph. No.
What are we looking at?
It's the guy that has his hands together and
Well,
he's stressed. There we
that's
go.
really sad. I apologize.
That's
Thank you
okay.
very much. Appreciate that. All right. Sorry about that. So let me just recap again because I was circling these. Those are the shoulder years, shoulder months, January through May, and then October through December. Cash flow looks great. Gross profit looks great. But then and gross profit being cash sales minus cost of goods sold, but not your fixed expenses that you've got like insurance and rent and employee payroll and all of the other things that we'll look at in a minute. But the net operating income might look something like this. I lose money in January, February, March. Maybe I break even in April, maybe not. I'm down in May, and then I start making money June, July, August, and I make income in September, and then it starts going negative again, October, November, and December. This is a little more typical for a seasonal business. The challenge is, what do I do about that? So the first thing is, one of the things that we do at the small business development centers is we do a lot of work with modeling cash flow. So if you don't model your cash flow, this is something your SBDC advisor can help you with. And basically looking at your cash sales, any other money that's coming into you, and then looking at your cash paid out, gross wages, payroll taxes, supplies, repairs, advertising, anything that goes into your business that you have to pay for on a monthly basis. Um, and that will tell you how much cash you're going to have at the end of the month going forward in time. And this is one of the things that you need to do in order to establish a baseline and to understand how your business is operating. So a cash flow projection that goes out at least for 1 year to 2 years is something that can be very useful to you. So this can be done as an extract from your QuickBooks. If you're using QuickBooks, or if you're using a spreadsheet, you can do it that way. But putting a time-phased cash flow together so you know exactly how much money is coming in and going out is an important part of this modeling effort. Now, the next thing that you would do if you've got cash flow is you can start modeling what do your year-round operations look like. And I draw your attention to all of these lines like advertising, automobile charges, insurance, interest expense, office expense, wages, etc., on a monthly basis, as opposed to your gross profit, revenue coming in minus COGS. And at the bottom, we'll be able to look and see what is your net income. And anytime your net income is negative, it'll show up as in parentheses or negative or a red or a minus sign. But it's important to take a look at these shoulder months and see where are you going negative and where are you going positive. And as you can see with my business in 2022 is highly seasonal, and these shoulder months, we tended to lose money, and that was to be expected because people don't buy as much ice cream in the fall and in the winter. Um, the next thing, if you're modeling your year-round operations, another thing that you uh, should do is now look at your seasonal operations and say, what would happen if I stopped spending on my advertising, my auto charges, anything that I could cease because I'm working in the wintertime as opposed to the summertime, anything that I can take out of my cash flow projection that I wouldn't have to pay if I were to close. And that'll give you a different baseline. So now you'll see I'm losing more on the order of $1,800 to $2,800 per month. Not quite so much, but still losing money in those shoulder years. And as you go through your modeling, there are things that you can play with. So for example, I lease my property from myself, so I can say I'm not going to pay myself any rent in the off season because I'm able to handle that. However, some businesses, you might need to have that rent payment in order to cover your mortgage and so forth. The same thing could be said for um, wages. Maybe you need to pay yourself in the wintertime, or maybe you don't need to pay yourself in the wintertime. But you use this cash flow spreadsheet to start developing scenarios that will help you understand, does it make sense to stay open or does it make sense to close? But there's another use for this kind of modeling as well, which is, okay, um, which is figuring out how much money you need to keep in your bank account in order to sustain yourself through those off-season months. In this case, if I look at the model for seasonal cash flow, now I've got my gross profit months here. Whoops, excuse me. And I've got my net operating income here. So you see, I'm showing losses in the off shoulder months, but I'm not showing as big a losses. And if I look at the comparison between year-round versus seasonal cash flow, you see that I'm showing a difference of about $23,000 in annual net income. So if I cut out those winter expenses and I decrease the losses that I'm experiencing in the wintertime, I should be improving my annual net income, even though my sales numbers are lower, because I've taken out those seasonal expenses that I don't have to spend. So the next question is, okay, so I've done some modeling with my cash flow, but I've still got this issue with I'm waking up at 2 o'clock in the morning in February, and I'm wondering, how much cash am I going to need in the off season? Do I have enough to go through the spring? So the best time to do this is at the end, is to do it continuously, but to look in September or October to see what is your cash position. Use your cash flow model to identify what the total deficit would be, and then figure out what your cash needs are to start up for the next season. So again, back to modeling the seasonal operations, I look at my losses that I'm going to occur if I'm, in this particular case, I've decided I'm going to run just a seasonal business. And now I start looking at, okay, how much am I going to need over the winter time in order to get through to the summer? So I've got this total for the shoulder years in the beginning of the year, this total for the October, November, and December that I might be experiencing. And then I think about, well, how much cash do I know that I need to have on hand in order to be able to start up in the spring? I might have debt servicing to worry about. I kind of made these numbers up. I might have rent that I've got to worry about, but this would tell me that I need to have about $60,000 available to me in order to cover me through the winter to go into the next season. Now, um, Dominic is going to talk about what your bank can do for you and how the bank can help support this, but I'm not advocating that you would borrow $60,000 in order to make it through to the next year. But what you would want to do is worry about this number particularly. Make sure you've got enough cash to cover your deficits, but then focus in on how much money do I need in order to start up in the spring. And I will tell you that in my own personal experience, the biggest worry that I've got isn't, can I cover my bills in the wintertime? It's, if I cover all of my bills in the wintertime, am I going to have enough money in order to start up next spring? And this is where Dominic is going to come in and talk to you about some of the tools that a bank can offer to help you not be quite so anxious about that. If you feel that you've got enough cash in the bank to cover your expenses, one of the things that the bank can do is help you eliminate that concern about your startup expenses for the next year. So the cash reserves approach, which I had been using to date, pretty much, where I don't have to worry about interest payments. I have to budget for unforeseen expenses. It seems like every January, for some reason, I've got to buy compressors for my freezers and all kinds of things that add more stress to my winter cash flow. But when I'm just drawing down from my own checking account, my own reserves, even if I know that I've got twice as much as I need, I'm still staying up at night worrying. So the question is, will there be enough left for startup next spring? And that is what Mr. Efter is going to help us talk about. So Dom, take it away. I'm going to check in the chat and see whether or not we have any questions.
Sounds good. So basically the first slide is going to be what can your bank do for you? So what we provide is we provide many products and services that will assist you in running your business. So they include deposit products, checking and savings accounts, standard products, talking about the reserve model. The savings account is very important. So as you're building up your checking account and you're not using those funds during your busiest time, you are putting some money in a savings account that is earning some type of interest and growing there. The next thing you look at is your, next thing we offer is business credit cards and business lines of credit. We're going to get into detail in those two categories in a few seconds. That'll explain to help you get through the anxiety and give you your startup cash that you need for the service. Other things that banks work, we have payment services, accounting services, and payroll services. So the one thing I'll mention about payroll services, if you own your own business, if you have W-2 employees that you pay, a payroll service is instrumental for a couple of different reasons. One, they will draw the taxes out as you're doing your pay. So you no longer have to worry about making those quarterlies on your own. The payroll service does it. They do all of the accounting for you regarding that. and they give you everything you need to pay your employees, including set up direct deposits, and the fee is usually not nominal. So I would definitely look at that. Depending on the type of business, if you're a single person contractor, accounting services is very important. If you're not a QuickBooks guru and you're not comfortable with it, some banks offer accounting services that can run it for you. There are also in the Hancock County area plenty of people that actually do that for you for a small fee. And payment services, basically how you're going to collect your funds. One of the things on the next line is merchant services, and that's basically credit card services. Sorry, payment services is more like a bill pay process. How do you make your payments without having to write a physical check? Make it easier, make it smooth, and make it efficient. Merchant services or credit card processing and auto pay. So if you own multiple apartments and you're managing it that way and you want to collect your rent without checks, this is a way to do that through merchant services, whether you use a debit card, whether you use an auto draw. And then treasury services are more designed for higher end clients that are getting multiple checks. So if you're a client that has 100 apartment units and you're getting 100 checks every month, then maybe a treasury service product is for you. Some way to make deposits, not just mobile banking, not just snapping a picture of a check, but more of a product that'll actually get you through that, make it easier. And the most important thing that your bank should be offering, and I know we do it here, but it's very important to check with your bank, is advice. You should expect that out of your bank 100%. If you walk into your financial institution and they don't offer you advice when you have a question or your concerns, then there's plenty of banks in this community, and I would suggest you look at other ones, mainly because it's very important that your bank is your partner, not just somebody who provides a service. One of the things we do at TD Bank is there's a link on our small business resources page. It's free to non-customers as well. So if you don't bank with us, that's fine. Go on to TD Bank Small Business Resources, and there's a whole bunch of information that'll actually help add to this presentation. So now you can switch it. So the first thing we're going to talk about two things. We're going to talk about the business line of credit, and then we're going to talk about business line of credit, then we're going to talk about business credit cards. We're going to talk about business credit cards first, because I think the most important thing you need to know is how to structure your spending. So a lot of people will use a business credit card and then panic because they don't want to make the payment out of their checking account because they draw down their available cash. That's where the business line of credit comes in. So you can flip the slide. We'll talk about that. So business credit card, it's really a crucial part in managing your cash flow, as well as creating payment flexibility. And I'll give you what I mean by that. So using a business credit card allows you to use the bank's money for a 30-day period. So you make a purchase, you make a purchase on the second of the month. You don't have to make a payment until the following second of the month. It's actually a little bit longer than that, but for this purpose, you don't have to make that payment before you accrue any interest for at least 30 days. What that does for you is it gives you the ability to use the bank's money at no cost. Now, the timing does change a little bit. If you make it near the end of your cycle, you do have to pay it earlier. But depending on how you use your credit card, if you're in a routine, it'll be about 30 days. The beauty of this is, again, you can spend a lot of money and not have to make any payments for at least 30 days. The other thing regarding it is you can earn rewards. So it sounds a little odd, but I'll give you an example of a small business. So there was a small business that I know of that has been doing business for years in town, and they sold their business, and at the end of it, they were clearing up their corporate credit cards. When they cleared up their corporate credit cards, they had $80,000 worth of rewards that they were able to claim at the sale. That is $80,000 that were rebated cash that they were able to get. They earned 2% of every transaction. So the amount of money, they put everything they possibly could on a credit card. And at the end, when they sold their business, there was an additional $80,000 on top of the sale. That is absolutely huge. And if you use those funds every year, then you actually can add to your business, whether you need a new machine. Eric mentioned the compressors. If you have a situation where you have a couple of $1,000 worth of rewards and you have to make $1,000 payment on something, then you just cash in your rewards and you can buy that, and it's no strain on your cash flow. So a business credit card is great from the rewards standpoint. Another thing, applying for it is simple. I know most banks were all pretty much the same with the application process on a credit card. It still needs to be approved. It is a credit application, so they will look at credit. They will look at other things, which we're going to go over in a minute in the next slide. But it does have to be approved. It is a credit product, but it is definitely a crucial part of managing your cash flow. Next slide, please. So let's talk about a business line of credit. So it's a vehicle that will assist you in scaling your business to take on larger projects and crucial winter cash flow option. Let's talk about the scaling for a second. So say, for instance, you're a contractor and you're doing, and you get a job doing business for, I don't know, I'm looking out my window, I could see Harbor Freight. So you get a job, you have to do a contracting job for Harbor Freight. What Harbor Freight would not do, like any large business, they will not pay you upfront the deposit. Usually, if you have a personal, you're doing work for me, like at my house, we're going to give you like a 30% deposit so you can buy materials. And that's usually how it works. But when you're dealing with a municipality, a large business, you don't get that deposit. They expect you to put the money up front and then they pay you when the job is complete. What a line of credit will give you is the ability to take on those bigger projects because you're able to use the line of credit. So using Harbor Freight as an example, Harbor Freight gives you the job, you need $20,000 worth of materials. You go and use your credit card for $20,000 in the materials. In 30 days, you're doing the work, but in 30 days, the credit card's due. To avoid the interest payment on the credit card, you take it out of your line of credit. You pay your credit card down to zero. And then within 30 or 60 days later, the job is complete. Harbor Freight pays you, you pay the line of credit off, and then the balance after that goes into your bank account and it grows your cash. Really as simple as that. Talking really quick about the pros and cons of a lines of credit. You pay for what you use, so you're absolutely not paying any money on anything if it's just sitting there. You have capital on hand for emergencies, as well as what I just mentioned for projects, and funds replenish as you pay back. So if you're comfortable with a home equity loan, it works exactly the same. You have a home equity loan for $10,000. You use the $10,000 for repairs. You make a $2,000 payment over and above your interest. You can use that $2,000 again. So on a business line of credit, that is the biggest advantage. That money is reusable and it's renewable every year. Every financial institution will do that. Lines of credit are renewable every year. And I'll tell you that what causes it not to be renewed in a few seconds, but those are the biggest pros on that. On a con, it definitely can have higher interest rates. Again, it won't have as high as interest rate of a credit card. So if you're paying the credit card, that's going to be somewhere around 18 to 20%. If you're paying off at zero, and you're using the rewards, you're not going to pay any interest in the credit card. A line of credit in this rate environment could be 12 to 14%. It could actually be there depending on your credit, and I'll go over that in a few minutes. Limits can be lowered than the term loans. So it's not going to be something like, so if you get a term loan and you borrow $50,000, like Eric's number, about $60,000 that you would need to go into the next year if that was your situation, you get a term loan, you probably wouldn't get the limit of $60,000 on a line of credit because it's based on your annual sales and some other calculations. So the limits will probably be lower, but because it's reusable, you don't need a higher limit. That is really important. And some banks will charge draw fees per transaction. We don't, and most of the banks in town that I know of do not as well. So if you're in Hancock County, you're probably going to be fine. It's more of the larger financial institutions, Bank of America, that type of thing, that have a lot of these built into small businesses. So that is just something you got to keep in mind when you are applying for it and you're getting one. Next slide, please. So how to obtain it? So it's a credit product, right? So you're going to go through an underwriting process. So I'll give you an example. You fill out the application, and I'll go over that in a second. So the process what bankers will look at will be the 3 C's. We like to call the 3 C's because we have an acronym for everything in this industry. The first C is credit score. If you have rough credit, personally and your business, it'll be real tough to obtain a line of credit. But if you have good, solid credit, you're already a third of the way there. The next thing is cash flow. So if your business is earning, and every bank has their own criteria, so I won't bore you with numbers, but if you're having a good, solid cash flow, and like the example that Eric showed, where you have a solid seasonal cash flow, but you on your shoulder ends, you have a lower cash flow, that's fine because they look at what they call your global cash flow. So where are you at the end of the year? If you're making money and you're showing positivity, you'll be able to get that. And the other thing is collateral. So a bank like us, and I'll use us for an example because this is what I do know, is our collateral that we take for lines of credits is going to be usually accounts receivables. So say, for instance, you do that Harbor Freight job and you get $50,000 in an account receivable that you're not going to get for 30 days, but you know you're going to get it. You build them, it's an accounts receivable. We will take that as collateral because we can justify lending you X amount of dollars, knowing that you have X amount of dollars coming in. And as your accounts receivable grows, as long as they're not delayed and you're not waiting a long time to get it, if they're rotating 30, 60, and 90 days, we will take that as collateral. And all banks will do that as well, but they all have different numbers that they look at. So can't speak for everybody, but we definitely will take that as collateral. So those are the 3 C's. You'll hear, if a banker is going to give you solid advice, you'll hear them tell you that. That is very important to understand what that is. Applying for credit requires an application to be filled out, as well as documents supporting those 3 C's. An income statement to show your cash flow, a balance sheet to show your accounts receivable, and depending on the type of business, we might ask for tax returns. For our bank and most smaller banks and most larger banks that are out there will not ask for tax returns for anything under $100,000. If your credit is solid and you're showing good cash flow based on a statement, an income statement, and a balance sheet showing your receivables, that's probably all we'll need for a line of credit. Once reviewed, the application will be decisioned and it'll be granted or declined. So simple that way. And again, not all banks look at collateral the same way. Some of the smaller banks that they run a tighter lending environment, they might ask for more. Some of the larger banks that are large, you might not have to be asked for that much. Like ours is pretty simple. We call it a signature loan. If your income and your balance sheet, income statement and balance sheet, and your credit's good, we're going to be fine. That's going to be an easy approval for us. So next slide, please. So I'll give you an example how a line works. If you look at it below, so the first graph is lender approves a credit limit of $100,000. The next thing, you purchase supplies or inventory if you're running a retail store, or you're running an ice cream shop, right? You want to use, you need to build up your, you need to start for your ice cream for your next season. So you're going to purchase $20,000 worth of supplies. The next month, the business is starting to do business. You pay back half of it because you're just ramping up. So you pay back half of it, as well as any interest that accrues for that 1 month. Keep in mind, the beauty of a line of credit is you're only paying for what you use. So in this case, use $20,000. Say the interest is $20. I don't know, it's going to be more than that, but I'm just using it for this example. You pay back $10,000 plus the $20 for that month's worth of interest. And then the next month you're paying the other $10,000, now only $10 worth of interest because you paid it in half. And now you have the whole $100,000 available again. So the way I tell people to use their line is use their credit card first, because it gives you that 30-day window. If your business is already ramping up and you don't need to use your line, it's great. You don't have to use your line. Pay it down with your free cash flow. However, if it's not ramped up yet, use your line of credit to pay it down so you're not paying that exorbitant interest rate on the credit card, and you're really maximizing your returns on your rewards. And then use your line and then use this structure. Very simple. Next slide, please. So let's talk about how the usage works. So an example of the usage on a line of credit is as follows. You need I'm just going to repeat pretty much what I just said, is you purchase materials for a large customer when the deposit can't be obtained, like such as municipalities. The project is complete. The customer pays the invoice, you pay the line of credit to zero. The only thing you're paying is you're paying interest accrued for that short period. Another usage is starting up your business for the season. Like Eric said, you run into it. I talk to a ton of businesses and everybody has the same comment, and Eric put it perfectly. They stay up at night wondering if they're going to have their startup cash flow. It mainly happens with retail shops. So seasonal retail shops really struggle with filling their inventory. So they go to their retail shows in January and February, they order their merchandise and they have to pay it. And a lot of them will run just credit cards and they'll put themselves in a really, really tight position. So having a line of credit will give them a lot of free flow and it just allow them to move in. And it actually helps you not to use your cash flow, your cash. So your free cash that you run into the season should help you live through the season. That's what it is for. And then the line of credit's designed to ramp up during your off season, the ramp up before your season starts. Line of credit's a purchase startup. If I said that, one major restriction of a line of credit, this is really, really important. Most lines of credits have a 30-day pay down. Keep in mind, people hear that and they think, oh yeah, for 30 days of a year, I can't use it. That's incorrect. So, and if your bank tells you that, that is incorrect because no bank requires that. What the 30-day pay down is, you borrow $10,000, you pay it down to zero for 5 days. You borrow $10,000 again, you pay it down to zero for 5 days. If over the span of 1 year, you have it at zero for 30 days, then you meet that requirement. That is really, really important to understand that. No bank expects you not to use your line of credit for 30 days. Matter of fact, we get paid because of interest. So believe me when I tell you, use your line of credit. We like that. We just want to make sure we show an up and down, concept, right? You're using it, you're paying it off. You're using it, you're paying it off. The biggest mistake people make on their line of credit is they draw it all out. And then they're so afraid of using their cash to pay it down, they don't pay it down. So they run an entire season high. The bank calls them and says, you can't do that, so you have to pay it down. Now they've already used their cash flow for something else. So the beauty of paying your line down is you can reuse it again immediately. So keep that in mind. Next slide. So the summary of my part is, like Eric said it perfectly. I couldn't have explained it any differently. By the way, if I apologize, I have two screens up, so if I look like I'm looking to my right, I am. But the camera's in front of me. Do your cash flow analysis, and I agree. You have to make sure that the SPD advisor helps you with that if you don't understand it. But if you do understand it, do that. It's very important. This is still my part, right, Eric? Yeah. No.
It's your part. I think I wrote it, but you're doing great. So keep on.
Okay, I'll keep going. Okay. So your SPD advisor will definitely be happy to help. Model your seasonality, understand what your needs are. Absolutely. To know where you're at. And you all know your season. There are businesses that do more in the winter than they do in the summer here. So you're the opposite. Good for you, by the way, if you can figure out how to get summers off. That's awesome. And cherry pick your opportunities for cash if you're a retail business. So, sometimes you want to use a bulk of your cash to do a particular project, whether it's an upgrade, whether it's buying inventory. Manage your cash and monitor it. And again, from my perspective, work with your banker. We get the concept of seasonality. It's very important to, and again, I go back to that original slide, advice. Your banks, one of the reasons why we put so much on our website to help people kind of have the info they need is because it's important to provide advice. We do not do well. No bank will do well for a business that fails. So our goal is the more successful you are, the more successful we are. So we can help you with anything. And I am always available. This isn't a sales pitch to sell my bank. This is more so I talk to clients who are not my clients all day long. If you have a question and you're just curious, you're more than welcome to reach out. I'll be more than happy to answer your questions. It's my job to do that, and it's kind of my community responsibility. So.
Awesome. Well, thank you, Dom. And I will say Dom has made it his objective to be voted the most approachable banking resource in Hancock County. We have lots of great banks and bankers that share his philosophy as well. I'll go back to this cherry pick seasonal opportunities because there was another thing that I've certainly practiced, which is this last season. I kind of looked at periods of time when even in the shoulder seasons, I got maximum cash flow. So for an ice cream store, it's around Thanksgiving and Christmas and maybe Valentine's Day and Easter and so forth. So rather than being open, we switched to a model where we're doing pop-ups, and that enables us to maximize the cash, minimize our expenses, but take advantage of those retail opportunities as they come up in the off season. So I'm going to pause for a second. There's a meeting chat that's open. There are no questions in here right now, but I'm just going to provide a moment or two for any questions if they come up. Otherwise, that's the end of our presentation. And if you are interested in getting SBDC advising services, again, go to www.mainsbdc.org. And there's an orange button, and you just hit that to request business advising, fill out a form, and we would be more than happy to help you. And I think I will close out for there. I got a thank you. So thank you back to Sarah too. And please reach out if there's any way we can. Oh, hang on a second. I got a question. Great. So for lines of credit, do you get penalized for not using it? For example, you don't need it for months. Dom? Oh, you're on mute, dude.
Sorry about that. I do that all the time. The answer is no, you don't get penalized. A line of credit will charge, most banks will charge you this is usually the standard number. It's a $250 annual fee. So basically to process the line of credit, you're going to pay $250 to do the renewal. And so at the beginning, depending on if a bank's running a promotion, you won't get charged that initial fee of $250. But if you do, you'll pay that. That covers the bank's underwriting. There is no monthly fee and no penalty for not using it. So the whole idea is if you don't need it, don't use it. However, keep in mind, don't absorb credit card debt because you're afraid of using your line. I think that's where the biggest mistake is made. But your only charge is going to be that one annual renewal. And sometimes banks charge it. Most of the time we do. So I think you're going to see that across the board in all financial institutions, but no penalty.
So back to Dom's point about people sometimes building up their line of credit because they want to keep that cash position, solid. Makes a lot of sense in a lot of ways because we're so paranoid about not having enough cash. But one of the things that will really solve that is if you're modeling your cash flow and you really understand what your actual needs are now and what your needs are going to be in the future, you'll be playing less defense without really knowing why you're playing defense. And you'll take advantage of that line of credit because you can see where you're going to be able to pay it back. Any other questions for the chat? All right. Well, I would say then that we will wind things up and thank you again. And please consider SBDC to be a resource for you. We have a ton of helpful videos on our YouTube channel as well as on our website. And thank you again, everyone.